Fast forward, if you will, to last week's Labor Department number. They surprised investors, Dr. Faber, with a better than anticipated unemployment report. Of course, the domestic economy shed approximately 539,000 jobs in April. That was much lower than the 600,000 that they had originally expected. This unemployment rate is nearly 9% now in the U.S. So we've shed about 6 million jobs since the recession began here in December of 2007. Now that unemployment is slowing, do you believe we're out of the woods, or should we be bracing for a double dip?
No, first of all, if we look behind the figures that were published last week, actually the employment figures were horrible because they shed 539,000 jobs. That was less than expected. But it included 226,000 jobs that the government created through birth death adjustments. In other words, they were assumed that new jobs had been created. I think this is a wrong assumption. Secondly, a lot of the jobs that were created last month were actually in government and also in healthcare. So if you exclude that, actually the jobs report was very bad. But the market wants to go up, basically, because of the money printing. If you throw enough money at the system, you can create huge rallies in asset markets. And I have to say, many commodities have actually rallied more than the U.S. market. The S&P is up 37% from the March 6 low, and other markets are up much more. The Russia Templeton Fund is up 170% since February, and so forth. So you have asset classes that have gone up much more, and yesterday we had a first real break in the U.S. dollar. This will be the pattern to come, that maybe the U.S. stock market continues to go up, but the U.S. dollar continues to go down.
You touched on the domestic stock market. I'm sure you'd agree that the pendulum had swung a bit too far into the bearish camp.
That's why since the beginning of the year, I saw a technical improvement in the market amidst a terribly oversold position, in particular as we went into the second half of February and early March. And actually in a Bloomberg TV interview on March 6th, at the day the market reached a low, I said the market should rebound very strongly from here, and I had a target of about 1,000 on the S&P. Now, I think recently the market on a very short-term basis has become overbought. In other words, we're not terribly overbought on a, say, 200 days basis, but on a 50-day basis, we're very overbought. And so I think a correction could occur anytime soon.
I agree with you, because if we look at the NASDAQ, although the S&P and the Dow Jones had a spectacular, almost blow-off close on Friday, closing near their highs, if not at the highs, the NASDAQ did not participate with only a 1.1% advance.
Is acting worse than the overall market, and that would make me a bit suspicious. And also the advanced decline line has begun to weaken somewhat. I would think that the correction could come. And even if it doesn't come, we had a 37% move from the lows, and say the market goes to 1,000 straight from here. We're talking about another 10%, and some stocks won't participate. The gravy is out. The gravy was to buy resource stocks in early December, Freeport, McMoran, Newmont, and so forth and so on, and essentially other stocks and financial stocks a month ago, 2 months ago, and now it's not so evident any longer that the risk-reward is particularly favorable on the long side. I would be a little bit careful here to jump into the market with all the money I have and with mortgaging the house to buy equities.
There's considerable talk by folks like Nouriel Roubini, Dr. Martin Weiss, and others who are concerned that this could be nothing more than a 1929-style bear market bounce. These very strong updrafts giving an opportunity for those who hadn't sold yet. Do you see any signs that we could retest or even break to further lows, perhaps by late September, October of this year?
We have to be aware that the worse the economic situation becomes, the more our dishonest money-printing team at the Fed and at the Treasury the more they will print. So what you could get in real terms or dollar adjusted a new low, in other words, what could happen? Say the market could rally 100% here. I'm not forecasting that, but it could if you print enough money. At the same time, the dollar could collapse by more than 50%, say, against gold and other commodities or some foreign currencies, the resource-based currencies, the Australian dollar, Canadian dollar, New Zealand dollar, have all been very strong recently. And so that could happen, that you have a bull market in equities in the US and a bear market in dollar terms. And I think the problem is to make any forecast about prices when you have a central bank printing money. It becomes very difficult. All I can say is it's going to be extremely volatile, and I would not rule out new lows because I tend to agree the economic situation has stabilized. Maybe we get a small rebound in economic activity into the second half of the year, but maybe we get another downdraft in 2010, 2012, who knows? All I want to say is it's very difficult to make any forecast. A 37% rise in stocks for me is a bull market, even if it leads to new lows thereafter. So we had a bull market since March 6th up to today. As of today, I'm not so sure anymore. So as of today, I would rather focus on Asian stock markets because in October, November of last year, many Asian stock markets reached 20 to 30-year lows. And these are important lows, in my opinion. I don't think we'll make new lows in Asia. But we can also have a meaningful correction because a lot of markets in Asia, they're up 70% from the lows.
You know, last week the CRB and the crude oil indexes broke out of significantly broad trading ranges.
The CRB has a beautiful head and shoulder low.
It appears to have registered an important market bottom, as you correctly point out. Do you believe that precious metals investors are going to benefit from this, or is there sort of the tendency to move away from safe haven investing as crude oil comes back into favor and stocks move up?
Well, I think you put it very well. You see, 2008, everything goes down except the US dollar, US bonds, and precious metals, especially gold, performed well in 2008 compared to everything else. As a result, by year-end and 2008 and early 2009, gold was very expensive compared to the CRB index, to a broad index of industrial commodities and other commodities, which had collapsed from 473 in July 2008 to 200 at its low. And also gold became expensive, relatively speaking, compared to the Dow Jones. Now, we can have, as money flows back into riskier assets, corporate bonds, equities, emerging market equities, and also industrial commodities, we have an underperformance of gold, or maybe even a decline in gold, vis-a-vis the other investments that are all now in rebound mood. So I think that gold may probably sleep for a while. I haven't sold my physical gold because I want to be my own central banker. I wouldn't trust for a minute a person like Mr. Bernanke. Is a money printer, nothing more than that. A degree, okay. I know lots of people who have degrees. Doesn't make them qualified to be a central bank president.
I don't think you would advocate his handling your finances.
Well, when you look at the picture of him, would you like to do business with him? Would he be your partner in any venture in the world? I don't think so. Now you look at the face of Mr. Tim Geithner. He looks